Welcome, and thank you for joining me for this episode of the Market Whispers podcast. I am your host, Beachman, and I'm super excited to have you here today. Today is Friday, February 16th. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes a month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, and from the active chat line as well as from this podcast. Most recently, I wrote to my paid subscribers about a highly underrated AI winner that's actually enabling the AI cloud infrastructure build-out tailwind. And coming up, I'm going to keep writing about more interesting AI investment opportunities. We'll talk about one of them actually in this podcast today. So please consider becoming a paid subscriber. Tell your friends and family, and I'd love to have them and you join the growing Beachman community. Now on to the meat of this episode. Let's start by talking about the current state of the markets. As you know, markets remain buoyant. Both the S&P 500 index as well as the NASDAQ continue to rise to all-time highs. The S&P 500 has in fact risen for 14 of the past 15 weeks. And this Friday morning, as I look at the weekly chart of the index, looks like it's going to notch on another week of wins. So it'll be probably 15 out of the past 16 weeks where the index has risen higher than the previous week. This is the first time this has happened since 1972. In fact, the S&P 500 has not fallen more than 2% in a day since all the way back to the year 2022. So for more than a year now, the S&P has not fallen more than 2% a day. That's really some bullish moves in the index. Now, as we try to make sense of the markets, one of the things that I've been paying close attention to is what's happening in the options market. As of today, call skews, which is the measure of put to call ratios, put options versus call options. So these skews are very heavily tilted towards call options. This has happened in the past. In fact, very recently, this has happened in July and December of last year. And this was followed by some sharp reversals in the markets. So what happens is when more and more traders or even investors buy call options, market makers are on the other side of those trades. They sell these call options to these investors or traders. And these market makers have to hedge their positions. And in order to hedge their positions, when they sell call options to investors or traders, when they sell more call options to investors or traders, they hedge their positions by buying stocks, by buying those underlying stocks, for example, NVIDIA or ARM or even SMCI. And then when these call options expire, now today is a major monthly call option expiration, February 16th. This happens every month. It happens every quarter. It also happens every week for many stocks. When these call options expire, those market makers no longer have to hedge their positions. So they end up selling stocks that they're holding within their hedges. That's what you're seeing, for example, in the lower trading prices for some of these popular stocks as of this morning. What's happening today is we've got a major monthly expiration. I believe there are about $2.4 trillion in options expiring today. As these call options, most of them are call options, as these options expire today, market makers take off their hedges, meaning they're selling those stocks that they were holding within their hedges, and that is sending these stock prices lower. Even the CNN Fear and Greed Index is at extreme greed levels today. This has also usually marked a possible turning point in the markets. When a few stocks are more richly valued than the vast majority of the rest, as is happening today, we've also seen a sharp reversal in markets. This has happened during the COVID crash in 2020. This happened during the great financial crisis in 2007 to 2009. This also actually happened in the dot-com bubble during the year 2000. Another stat that I found really interesting. If we look at the percentage of stocks that are above their 50-day moving average, okay? So if we look at the percentage of these stocks that are above their 50-day moving average, it was as high as 90% of stocks traded until the middle to the end of January. That has now come down to just about 50% of stocks. So 40% of those stocks have come lower over the past 2 to 3 weeks. This is not a bullish signal in my mind. The S&P 500 and the Nasdaq are also trading at some of the highest PE ratios, price to earning ratios, since the early 2000s. So when this happens for any index or stock, typically what has to happen is either the projected earnings have to rise sharply in order to justify those higher valuations, to justify those higher PE ratios, or the indexes or the stock prices have to trade within a range for a while the earnings catch up to those valuations. This is typically how markets work. When I look at the chart for the S&P 500, I think the 4900 level is a key level that the index has to defend. And if the S&P 500 goes lower, below 4900, then we could get a much sharper decline. Now, as we also think about market conditions, one of the questions that keeps coming up on everybody's mind is, what will bring this market down? I think that it's going to be something in the commercial real estate market that's going to bring this market to come down. I think we're going to get some sort of breakdown in a financial institution like a small bank or even a mortgage lender that's primarily dependent on the commercial real estate market. Now let's talk about this a little bit. The commercial real estate market is a $5.8 trillion market. As per Moody's, almost 20% of office space in major US cities has not been leased as of the end of last year. This is up from 19% from a year ago. This commercial real estate issue has been creeping up as a risk for the past almost 2 years now. This high vacancy rate is some of the highest that we've seen since 1986. Now what happens is, after the pandemic, many large companies, this was mostly a large company phenomenon, many large companies went towards a work from home or a hybrid working model. This trend has continued to pick up. Currently, about 76% of global companies are either actively using or planning to implement a permanent hybrid work model. What that means is they don't need as much real estate, commercial real estate, to be leased or rented in large office buildings within these large metropolitan cities. As a result, commercial real estate prices have dropped. They have dropped more than 26% since the beginning of 2022. There is an estimated $2.9 trillion in commercial real estate debt that is maturing over the next 5 years. About $1 trillion of these loans are coming due in 2024. These commercial real estate companies will have trouble renewing this debt at very high interest rates. This is going to lead to another severe value contraction in the value of that commercial real estate. Almost 2/3 of this commercial real estate is estimated to be underwater today. It's estimated to be more than 30% underwater today, and this can only grow as we stay in a higher for longer interest rate environment. Now, regional and local banks play a massive role in the commercial real estate space. Most recent estimates have told us that these smaller banks, these local and regional banks, have lent up to $2.3 trillion against commercial real estate. About half of these smaller banks are now tightening their lending standards. And what happens is, when the value of this commercial real estate that they have lent against goes down, these loans that they have created on their books have to be marked down to the market price of this real estate. And then banks have to set aside more and more money in terms of loss reserves to counter the risk that they have on their books against this commercial real estate. This will lead to possibly more rising bankruptcies amongst this small bank community. We've already seen a few of these smaller banks go belly up this year and even last year. Now, Richard Excel at the Stay Vigilant Substack wrote about this recently. He gave us a very good example of a commercial real estate property that sold at a 90% discount. Now, Morgan Stanley sold this property at a 90% discount in downtown Chicago. Now, think about that. This property was sold for 10 cents on the dollar. So this CRE risk is a very large potential black swan risk that could hit markets over the next few months. Nothing else, to me at least, seems to be on the horizon as a black swan risk, other than the usual suspects. We have military and war action happening in the Middle East. We've got the Ukraine war. There's this constant risk of maybe China might attack Taiwan. Now, these have been around for months, and markets have really taken these risks in its stride. All the negative news about China is also already priced in or close to being priced in. Europe seems to be fine. Yeah, maybe it's in a little bit of a recession, but it's chugging along. Latin America seems to be humming along as well. So we'll continue to track these risks. We'll continue to track what's happening in the commercial real estate market. And of course, we'll look out for any other potential black swan events that could impact our portfolios and the markets at large. Now let's turn our attention to some of the interesting macro updates that we got this week. This week we did get updates on some of the leading macro indicators that I follow. But let's start by talking about inflation. We got two important inflation reports this week. We got the CPI, or the retail inflation report. This came out a couple of days ago and it was hotter than expected. Headline inflation, which is the overall CPI index, was up 3.4% year over year, and this was higher than the forecast of 3.1%. Core inflation, which excludes energy and food prices, was up 3.9%. This was higher than the forecast of 3.7%. We also got the PPI, or wholesale inflation report, just today, just this morning. That was also slightly higher than expected. Headline PPI, or wholesale inflation, was up 0.9% versus a previous or December reading of 0.96. But the core PPI inflation, which is the core wholesale inflation rate, went up 1.95% year over year, which was much higher, maybe slightly higher than the previous December reading of 1.7%. So the two inflation readings that we got this year, retail inflation and wholesale inflation, both were slightly hotter than expected, and markets seem to have taken this in their stride. I continue to believe that inflation is a yesterday's story. As long as these indexes are trending lower, generally speaking, they're going to flutter up and down month over month. But as long as they're trending lower, we're moving in the right direction. And I also believe, I've talked about this before, I think that inflation is going to remain stagnant or stubborn somewhere between the 3 to 4% range for retail inflation and the 1 to 2% range for wholesale inflation. And we're setting up a new base of inflation that this country, that the US, is going to have to deal with for a longer period of time. Now, one of the leading macro indicator updates that we got this week was an update on the small and medium-sized business community. We got an updated reading on the NFIB index. Now, the NFIB index is one of those leading macro indicators that I follow, because small to medium-sized businesses control about 60 to 70% of all employment in the US. And if the small to medium-sized business community sees any shrinking in their business fortunes, this could lead to higher unemployment in the US, lower GDP or economic growth, as well as this could take the stock market lower. Now, the NFIB index fell to 89.9 points in the month of January. So it fell about 2 points from the December reading of 91.9. And we've got to dig in a little bit deeper to understand why this happened. What we learned from the index update from the report was that small to medium-sized businesses are seeing less business coming into their pipeline. The outlook for their future business has deteriorated a little bit. They're also worried about inflation. So inflation is hitting them now, along with high interest rates. And they're worried about their ability to hire good quality employees as and when they have job openings within their businesses. We also continue to monitor the price of oil. This is also one of those leading indicators that I like to look at. The current price of oil has continued to remain in the $70 to $80 range, as I expected. It is down from a high of almost $94 in late September last year, but it is up from the lows of $66 from March of last year. I continue to believe that oil prices will stabilize at these levels, at least for the next few months. It's going to remain stagnant. Global economic growth continues to remain under pressure. This is because of high interest rates. Japan, for example, just announced an economic slowdown for 2 consecutive months. China, as we know, is also in a slowdown. US retail sales were down for the month of January, much lower than estimates. Germany also announced that they're in a recession now for 2 months straight. Now, 2022 was a volatile year for the energy industry. We saw the price of oil range anywhere from $71 to $121. I'm not looking for that much volatility in the year 2024. As I said, I continue to believe that oil will be range-bound until we get some more clearer signs there's economic growth coming into the US as well as around the world. Until we see signs that there is more demand than supply. Today, for example, global consumption of oil is about 101.1 million barrels per day. But global supply of oil is slightly higher than that, at 101.7 million barrels per day. Even Russia is selling oil at $60 per barrel. So if Russia is selling, and I believe that they are the fourth or fifth largest oil producer in the world. If Russia is selling oil at $60 per barrel, and this is an economic sanctions-based price cap for them, if Russia is selling their oil at $60 per barrel, that's keeping a lid or a cap on oil prices going any higher than, let's say, $70 to $80 per barrel. So we'll continue to watch what's happening in the oil markets, but for now, they stay stagnant. And then if we turn our attention to what's happening with Q4 earnings, according to FactSet, at this stage of the Q4 earnings season, the overall performance of earnings reports is improving. The percentage of S&P 500 companies reporting positive earnings surprises is now above the 10-year average. This has flipped over the last week, while the magnitude of earnings surprises is still slightly below the 10-year average, so that has to catch up a little bit. More than 75% of companies in the S&P 500 have now reported their Q4 earnings. Of these companies, 75% have reported earnings above estimates, and the average beat amongst these companies is about 3.8% above estimates. So it looks like the Q4 earnings season continues to improve in terms of the quality of the reports we're getting, the magnitude of the beats that we're getting. Now, if you're curious about how the mega cap stocks have performed during their Q4 earnings season, the Mag 7 stocks have reported earnings growth of over 50% collectively over the last year. While the rest of the market, the rest of the S&P 500 stocks, their earnings have shrunk by about 10% over that same time frame. So we continue to see improvements in Q4 earnings reports coming out, but it's primarily dominated by large cap tech stocks that are reporting better and better earnings as compared to the rest of their peers within other industries. Now we've got a big one coming up next week, NVIDIA, which is the GPU or the AI darling of the stock market. NVIDIA is going to be reporting their earnings on the 21st, I believe, coming up next week. And talking about NVIDIA, I saw some really interesting information on what their AI GPU chips sell for. I thought this might be interesting to share with you. So we know that NVIDIA sells one of their AI GPUs for about $40,000. Now on eBay, those same GPUs are apparently selling for over $45,000 to $50,000 per GPU. And on the CDW website, those same GPUs apparently, or maybe a souped up version of those GPUs, are selling for as high as $98,000. And one of NVIDIA's largest competitors who just started making GPUs, AMD, or Advanced Micro Devices, they are now selling their GPUs for between $10,000 to $15,000 per GPU. So I thought this was really interesting, some real-time market information on what these AI wonder semiconductors are selling for. So let's shift gears again and talk about a company that recently reported their Q4 earnings. The company that I want to talk about today is called Palantir. Palantir reported their Q4 earnings about, I want to say, 2 to 3 weeks ago. And I had a very, very engaging and good discussion about this company with my subscribers, with my readers on the chat line around that time or shortly after they reported their earnings. We were trying to answer the question, is Palantir a good stock to consider? Now, my initial response to that discussion was negative. I've always had some reservations about the company and how they have been led and managed, and that was my initial biased response. It was a negative response. But this is what makes the chat line with my subscribers, with the Beachman community, so useful. Because I got challenged by one of my readers to say, what do you mean? Why do you not like this company? And this forced me to go back and take another look at the numbers and rethink my thesis or opinion about that company. So after a double shot of Java and a couple of hours of crunching the numbers, I came away impressed by several improvements in the business performance and the fundamentals of Palantir. Now, I still have some concerns about the company, but I found a lot more positives to like about Palantir at this time based on their Q4 earnings report. Now, the main thesis for investing in Palantir is their commercial business potential. They sell a bunch of AI and machine learning software to government agencies. Their government contracts have been growing, though, at only about 10% per year, year over year. These are large contracts. These government contracts are large, but they grow much slowly on a year-over basis. And Palantir's gross margins or profits on these contracts are much lower. So if I want to invest in Palantir, I'm much more interested in the potential of their commercial side of their business, their commercial customers, those contracts, because these have the potential to grow much faster, and the profit margins on this commercial business is much higher. Now, what I've seen is that their commercial business is now 47% of their total revenue. This is up from 42% just a year ago. So their commercial business is growing much faster, and that pace has picked up recently. Their commercial customer count has also been growing much more rapidly. It's been growing at an average of 10% per quarter for the past 8 to 10 quarters. Now think about this. The count of their commercial customers is growing 10% every quarter for the past 8 to 10 quarters. This is really nice growth. Their overall growth is estimated to be about 20%-ish per quarter for the next 2 to 3 years. 20% year over year for the next 2 to 3 years. And if their commercial growth continues to grow and expand at this rate, their overall growth could surprise to the upside over the next few quarters. Now, of course, we could also get a downside surprise because their products are costly. This is one of the concerns I have. They compete with companies like Snowflake in the big data space. Their business model is very consultant heavy. So for any new customer contract that they sign, as they're executing against that customer contract, they apply 2 to 3 of their consultants on every such contract at very high hourly consultant rates. They insist on adding these consultants on site at the customer site for most of the duration of a customer contract. And this costs the customer ongoing consultant fees that get billed to them. Because of this, their operating margins and their net profit margins continue to remain low and stagnant. On the flip side, on the positive side, one of the things that impressed me was their remaining performance obligations, their RPO growth. RPO grew 28% year over year in the most recent quarter. This is another sign of good commercial growth. Palantir is also showing expanding margins, expanding cash flow margins. They have higher cash on their balance sheet right now. They're adding cash to their balance sheet every quarter, and they have very low debt. Institutional ownership is also growing. This is always a good sign. But one of the other aspects of this is their shareholder dilution has been very high for the last 3 years at least. Shareholder dilution grew by 12% in 21. It grew by 4% in 22, and then it grew by another 13% in 2023. This is one of the most concerning things I have about the stock. Therefore, I believe that today's stock valuation is quite high given their forward growth rate and their continued share dilution. And the other aspect of the business of this company that I don't like is the caliber of the management team. I have watched this management team in action at conferences. I have listened to multiple earnings calls. I have watched a lot of videos when they're presenting or interacting with customers. And I've generally felt that they come across as very grating and egoistic and unreliable as a management team. Reminds us of Elon Musk of Tesla, right? But the Palantir management team takes this to a whole different level. If you don't believe me, just watch a few videos of how they answer questions at conferences and customer events. It comes across as if they have very high disregard for actually even listening to the customer question. Basically, their response is, well, you're an idiot. You don't know anything about artificial intelligence and machine learning. You're a fool if you don't use our product. We're the only ones who know how to do AI and ML. So you need to buy our products even though you think they're expensive. Now, I'm using some pretty strong language as I describe how their management team comes across to a potential customer. Just watch a few videos, just listen to a few conference calls that they've done, just watch a few conference events that they have presented at, and I'm pretty sure that you will come away with a similar impression. Now, Morningstar's fair market value for the Palantir stock is $15. Today, the stock is trading somewhere between $23 to $24. When I use my Beachman scoring algorithm to review the stock, they scored 16 points, which is quite good in my opinion. So overall, I really liked what Palantir reported in their Q4 earnings report. I like the fact that their commercial business is growing and it seems to be growing faster and that pace is picking up. I do believe it's an overvalued stock at this point, but I'm adding it to my active watch list. I'm going to continue to monitor Palantir, and I might even consider taking a position in the stock if I continue to see healthy business results and a decent valuation on the stock. So what's coming up in the markets over the next few days, over the next week? Well, one thing to remember is that markets are closed on Monday, February 19th. They're closed for President's Day. So it's going to be a short trading week next week. Markets will open up again on Tuesday, February 20th. And on that Tuesday, February 20th, we're going to get the Jan report for the leading economic indicator index. So that's all I have for this episode of Market Whispers. Drop me a comment or question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest, for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.